Last week, Jerome Powell set the tone across financial markets. Now, Wall Street is trading mixed in anticipation of a series of macroeconomic data. The focal point is inflation data and the Fed's preferable indicator. Apart from economic reports, investors will be alert to comments by Fed's policymakers. Another event to influence market sentiment is the bank stress test. All in all, investors are braced for another turbulent week, and the benchmark stock indexes finished last week in the red as expected. Overbought shares of the high-tech giants tailed a rally of the S&P500 and the Nasdaq. The Dow Jones lost 219 points, or 0.65% on Friday. The Nasdaq printed the heaviest losses, having dropped by 1.01%. The S&P 500 shed 0.33% to close at 4,348 points. The stock indexes traded mixed in the pre-market. The S&P 500 is expected to trade in the intraday corridor between 4,310 and 4,380 points. All stock indexes closed with losses on Friday because the market sentiment was hurt by hawkish remarks from Jerome Powell about further rate hikes. Despite promising US unemployment claims and Powell's pledge to take a cautious approach to raising interest rates, all three indexes went down as a result of a massive sell-off. Mega-cap stocks sensitive to interest rates have been hardest hit, led by Microsoft, Tesla, and Nvidia. As a result, the Nasdaq snapped its 8-week winning streak and the longest since March 2019, and the S&P 500 halted a 5-week rally, the longest since November 2021. The S&P 500 and Nasdaq recorded their biggest weekly fall since the March banking crisis, and the market may have taken in a lot of the hawkish signals of the Fed speakers. In addition to Powell, San Francisco Fed President Mary Daly said on Friday that 2 more rate hikes this year are a very reasonable forecast and confirmed Powell's call for caution in policy decisions. Atlanta Fed President Tom Barkin said late Thursday that he was not convinced inflation was a sustainable path to the 2% target, but added that he would not predict the outcome of the central bank's July policy meeting. According to the Fed Watch tool, financial markets are 74% likely to see another rate hike by 25 basis points at its July meeting. All 11 major sectors of the S&P 500 lost ground, with the utilities taking the biggest percentage loss. Chip makers put pressure on the tech stocks, with the Philadelphia Semiconductor Index down 1.8%. Wall Street opened the new week with a cautious sentiment. Futures for the US stock indexes remained under pressure, despite the fact that the part of the pre-market mega-caps were in the green zone. Pressure on the indexes was exerted by defense and oil companies, which fell by 0.3% and 1% before the opening bell. Investors are waiting for a number of important macroeconomic data later this week. The consumer confidence report comes out on a Tuesday after falling to a 6-month low in May, and the June index is expected to rise. In addition, the data of the National House Price Index will be released on a Tuesday, and the week will end with the PCE Price Index for May, the Fed's key indicator of inflation. Powell is also said that they perform again later this week. Last but not least, the market will get to know the results of a bank stress test. Testing in 2023 is expected to be more challenging than in the previous years, as the actual economic base is healthier. This means that unemployment increases and falls are felt more acutely. So analysts expect banks to be asked to allocate slightly more capital than in 2022 to account for the expected increase in the simulated losses. In addition, banks with large trading operations will be tested for a global market shock, and some will also be tested for the bankruptcy of their largest counterpart. For the first time, the Fed will also conduct an additional exploratory market shock against the 8 largest and most difficult firms. This additional test will not count towards banks' capital requirements, but will allow the Fed to explore the application of several adverse scenarios going forward. A total of 23 banks will be tested in 2023. That's down from 34 banks in 2022, as the Fed decided in 2019 to allow banks with $100 billion to $250 billion in assets to be reviewed every 2 years. Despite this, after the banking crisis in March, attention to the result will be increased. Meanwhile, some Wall Street banks take a stock rally with a pinch of salt, warning that elevated market quotes have made stocks vulnerable to decline. The S&P 500 is currently trading 19 times its expected 12 months earnings, well above its historical average of 15.6 times, according to Refinitiv data. Similar levels preceded periods of adverse results. Historically, the S&P 500 has experienced an average drop of 14% over the next 12 months, when the index is at the current levels or higher, compared to a 5% drop of a typical 12 months period, according to Goldman Sachs. Key risks that could dampen bull market optimism include weaker economic growth and more hawkish Fed and the recovery in inflation. Goldman urged investors to consider downside protection for their portfolios, although they expect the S&P 500 to hit 4,500 by the end of the year, about 3.5% above current levels. On the other hand, areas such as manufacturing, materials and mid-caps also performed better than these months, fueling optimism that the rally will extend beyond tech stocks. In the corporate world, Alphabet shares fell by 0.9% in the pre-market trading after UBS downgraded the stock to neutral from buy. Tesla shares shed 2% after Goldman Sachs downgraded the stock to neutral. Moderna shares rose by 3.1% after UBS upgraded the vaccine maker to buy. Last week, the US dollar found solid support from Fed speakers and its status of a safe haven asset. On a Monday, the greenback turned sour. Its index is trading at 102.70, 0.14% down inside the intraday corridor between 102.30 and 102.90. The US dollar index pulled back today after a 0.5% increase last week. The dollar closed with gains on Friday for the first time in months because PMIs showed that business activity in the Eurozone stalled in June due to a lingering slowdown in the manufacturing sector. The recession fear propped up the greenback. Besides, the US composite PMI dropped to the lowest level in 3 months. A slowdown in the manufacturing sector escalated, and still the overall picture revealed a modest economic growth in the second quarter. On a Monday, a survey showed that business morale in Germany worsened for the second month in a row in June, indicating that Europe's largest economy faces an uphill battle against the recession. And the euro responded to the data with a decline, but later recovered on the expectations of a Christine Lagarde speech at the ECB Forum 2023, which could give fresh impetus to currency pairs in the American session. The Canadian dollar is extending its advance, hovering at comfortable levels in the last 9 months. The USD CAD pair slipped by 0.13% intraday to trade at 1.3165. and the intraday Canada is seen between 1.3150 and 1.3210. The loonie received a boost from Canada's trade data released on Monday. According to fresh estimates, Canada's wholesale sales expanded by 3.5% in May from a 1.4% fall in April. Oil prices also gained a foothold. Brent futures rose by 0.7% to $74.40 a barrel, while WTI also grew by 0.7%. Oil quotes are trading under pressure. On the one hand, the market sees prospects for production cuts, and on the other hand, risks of a global recession and weak demand. Alarming calls from China and the Eurozone led to a 4% drop in oil prices last week. The situation is exacerbated by hawkish central banks and fears that regulators will go too far in trying to cool stubborn inflation. Meanwhile, the crypto market is opening mainly in the red. Popular cryptocurrencies are gradually retracing from the highs reached last week, and Bitcoin lost ground in midday but reversed in the New York pre-market to trade at $30,500 or 0.25% up. Top altcoins are trading mixed. Cryptocurrency assets are pulling back after a surge of optimism triggered by the fact that the Securities and Exchange Commission approved the first ever leveraged ETF on the Bitcoin futures. BTX is the first leveraged Bitcoin futures ETF. They can be divided into Bitcoin futures and Bitcoin sports. BTX, being a leveraged ETF, will use Bitcoin futures to increase the performance of the benchmark index. Trading on the Chicago BZX options exchange is expected to begin on June 27, 2023. Among other market news, Japan's new tax rules have exempted self-issued cryptocurrencies from a tax on unrealized gains. Under the revised rules, Japanese companies issuing tokens are exempt from the standard 30% corporate tax rate on their assets, including unrealized profits. Despite the positive sentiment and the approval of the Bitcoin ETF, the flagship crypto traded moderately on a Monday. At the same time, the asset continued to hold rather confidently above 30,000. Bitcoin is facing strong resistance at 31,000. The asset may open the week within a wide range of $29,600 to $30,800. Breakout of these levels will lead to the token either to a correction to $28,700 or to an increase above $31,000. Follow developments in financial markets on the InstaForex TV channel, and see you online tomorrow.